It's been about 2 weeks since the federal election, so I want to walk through some of the key proposals in the Liberal platform and what these potential changes could mean if you're getting close to or in retirement. We'll look at the proposed changes to personal taxes, capital gains, RRIF minimums, and then we'll finish off with a few broader items that are still worth keeping an eye on. So let's start with the proposed changes to personal taxes. The Liberal government has proposed to reduce the lowest federal tax bracket from a 15% rate down to a 14% rate. And while 1% isn't a whole lot, it could save the average couple or household about $825 per year. So while not substantial, it's still money back in your pocket. Now, a reduced tax savings like this for retirees could help you draw more from your RRIF, pay lower tax in your overall standings, which again puts more money back in your pocket, allows your money to last longer for you, or give you a bigger budget to keep up with the current inflation that we're seeing over the last few years. So as we move forward, keep an eye on this personal tax change. Again, 1%, it doesn't seem like a whole lot, but it could save you a few $100s every single year moving forward on your personal tax return, or allow you to pull more money out and have the same net after tax income. So let's hope this is implemented so every single Canadian can take a benefit of this. The second proposed change is the capital gains. And we saw this about a year ago where capital gains were increased to 2/3 from 1/2 on any sale of a capital gain property, real estate, investment, etc. So anytime you triggered a capital gain, previously we've been at 50% for many years, meaning that 50% of your gain is taxable, the other 50% is tax-free. About a year ago, Liberals bumped that up to 2/3. So 2/3 would be taxable, only 1/3 would be tax-free. Now, they've scaled back on that recently, and it's been a big mess, to be honest with you. If you ask any accountant, it's been an absolute mess dealing with that through the current tax season. Now, the proposal going forward is to keep it at 50%, but the Liberal Party hasn't been very open on what their stance is on this going forward. I wouldn't be surprised if we saw it go back up to 2/3. Again, I think they scaled back because they were in the middle of an election, but this was their stance less than a year ago. So will they revert to that and have that increase? Time will tell. But if you have something that's going to trigger a capital gain in the next little bit, be expected to pay 50%, but it could bump up to that 2/3, at 66 and 2/3. So just be aware of that. This is something that will be a hot conversation going forward. It's been over the last year, and I don't think that's dying down. So just be aware. I think capital gains, again, I've always said from years ago on this channel, it's low-hanging fruit. If the government wants to raise more taxes, typically people that are triggering capital gains have second properties and large non-registered investment accounts. Again, not all the time, there's exceptions to the rule, obviously, but as a government, if you're looking to raise more tax money, which they are because they're running at a huge deficit, this could be low-hanging fruit. So I would not be surprised personally if we see that capital gains jump back up to 2/3 from the current 1/2. The third item that could affect you if you're retired or getting close to retirement is the minimum RRIF withdrawal. So your retirement income fund, which your RSP, your retirement savings plan, converts to a RRIF when you hit retirement. You need to start drawing out, and there's a minimum amount that you need to take on an annual basis. Now, the conversation right now, and the Liberals have kind of had the stance on this, is that they're going to reduce the minimum amount for 1 year by 25%. Now, they haven't said what year they're going to do that. Will it be 2025? Will they push that to 2026? That is undecided and not out there. But let's assume it's going to be 2025, meaning that this year, your minimum RRIF amount could be reduced by 25%. Now, to me and to most of you watching this video, it shouldn't be that important, and I'll explain that here in a second. Now, we've seen this implemented before. Back in 2020, when COVID hit, they also reduced the minimum RRIF by 25%. And they really did that because the market had dropped so much. So they don't want people selling their investments when the markets are so far down, especially retirees that have less of an ability to kind of build that war chest back up. This is where your cash wedge comes in. Times like this in the market should not make you take 25% less out of your RRIF. You have this money set aside. Again, I'm not going to get into the cash wedge in this video, but if every retiree built a cash wedge like they should, things like this 25% reduction on your minimum RRIF should have zero effect on all of you. So again, if you're like, oh, good thing I have to take 25%, like you haven't built out your retirement plan properly. So that maybe needs to be revisited through this whole process as well. Now in 2020, when they implemented the 25%, if you had already taken out the minimum for the year or more, you couldn't put it back in. It was just what was done was done. So people that hadn't taken the minimum could take advantage of this 25% reduction. Now, if we go back to 2015, they did the same thing, 25%, but they allowed you to pay back some of it. So you could kind of make it up. Again, 2008, they did it again. So we've seen this again and again, and it's kind of been different rules every single time around, well, if I already pulled out my minimum, can I put money back into my RRIF and only be taxed on the smaller amount? That's yet to be determined. My assumption is if they roll it out, it'll be going forward. So if you've already taken your minimum, tough luck for you. But again, most of you, all of you, should be taking more than the minimum amount. So who does this affect? This 25% reduction? Well, it affects those of you that have gone back to work. So you converted your RSP to a RRIF and you have a minimum amount that you have to take out this year, but you're still working. Or maybe you sold a property that triggered some gains, like a secondary property, rental property, a vacation property, something that was triggering gains. Then yes, it will definitely help someone like yourself that can then reduce your RRIF minimum that you have to take out and reduce your overall tax bill. And you can push that into a future year and level that out a bit better. But for most of you that are just pumping through retirement, you should have that cash wedge. You should probably be taking much more than the minimum RRIF amount if you're doing it properly. And something like this shouldn't really affect you. So again, it's probably the 1% that it'll affect. And for those people, it'll be helpful. But again, we'll see if they actually roll this out and the rules they place around it. The fifth and final point I want to make here today is about the tariffs and the retaliatory tariffs that the Liberal government plans to put on the US. And this is really, a lot of it is in place already, but we could see this roll out. And it will all depend how much the US puts on Canada, that Canada will probably put on the US. And again, nobody has a crystal ball, including myself, but the Liberal government has been very forthright to say, look, we are going to go up against the tariffs. Now, what does this mean for you as a retiree? Well, probably higher costs. If you've gone online recently and looked at car prices, they've jumped up about 15 to 20%. The tariffs 25, they've jumped up about 15 to 20. So there's been a big jump. You'll continue to see that in a lot of items you're purchasing. Now, that will likely drive inflation. And again, if tariffs stick and they stick at the rate that they've been talked about on both sides and within many other countries, expect the cost to come up on almost everything we produce, consume, etc. It's going to increase. So obviously as a retiree on a fixed income for most of you, this could be a drastic impact. So keep a close eye on tariffs, what's going on in the States, how we counter those tariffs, and how this rolls out going forward. Hopefully it all comes in much less than we're hearing, but obviously this has a big impact. So if you're on a fixed income, if you're in retirement, the tariffs and what the amounts come around the tariffs will have a drastic impact on how much money you have left at the end of the day to spend. Because if everything goes up 5, 10, 15%, obviously that has a very large impact on what you're able to do through retirement. So every election brings some change. Again, this is what they've been campaigning on, the Liberal Party. We'll see if they roll any of this out, how it lands, how it helps you, how it affects you. And we'll maybe do an update on this in about 6 to 12 months from now to see if anything's happened. We'll see you in the next video.